Hey everyone, thanks for joining us today. I'm Megan Coelho. I'm the president of Advice Chaser. And before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are thrilled to bring you this educational presentation today on investing in rental properties for pilots. Attendees are muted, but we encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your contact information as well, so that if we can't get to your question, we can make sure someone reaches out to you after the event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. So I'll introduce you today to today's guests. Our moderator is Mark Seither. He's a partner and wealth manager with Kingsview Partners in Knoxville, Tennessee. He has a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor for Northwestern Mutual in La Jolla. Mark enjoyed finding innovative solutions to clients' complex problems, and his desire to work with the entrepreneurial mind helped him to thrive as a financial advisor. As Mark honed his skills as an advisor and a planner, he looked for a platform that would better pair with his desire to work with clients needing advanced planning and specialized fixes. He found his spot back in Northern California in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he has collaborated with Josh Saunders. I should have that slide up here for you. A retired Navy and current Southwest pilot, to build Kingsview Partners. Together, they assist individuals on wealth management and tax strategies, specializing in the needs of pilots. And our presenter today is Andrew Norris. He is a mortgage loan originator with Trident Home Loans, a mortgage company specializing in serving veterans and aviation professionals. Prior to joining the mortgage industry, Andrew flew for both commercial airlines after serving in the U.S. Navy as an aircraft commander and then as an instructor pilot. Andrew has a bachelor's degree from the University of Colorado Boulder and has served his community as a volunteer for Habitat for Humanity. So, Mark, I'll hand it over to you.
Thank you, Megan. Hey, everyone. We are very excited about today's topic. Josh Saunders and I, real estate can be an absolutely beautiful way to build wealth, and not only that, but pass it on for legacy planning. But it can also be yucky, right? And so you want to make sure you have a good team. And Andrew has been, Andrew's a phenomenal person to speak on this topic, and we're just excited for the information he's gonna drop on us today.
Thanks, it's good to be here.
Perfect. So on today's topic of investing in real estate properties, it really honed in on the pilot community. So Andrew, you're also a pilot as well. Can you give us maybe just a quick snapshot of your own personal experience in this realm as a pilot and as someone who dabbles in real estate themselves?
Yeah, so I was just looking for something on the side. I've always been fascinated in real estate because it's, one of the few things that's a finite amount. There's only a certain amount of it. So it's always kind of been in the back of my mind. But when I was in the Navy, we got stationed in Corpus Christi, Texas. And at the time it was 2011. So it was still kind of, the market was in the tank. And when we got there, we moved to North Padre Island, which is a lot of secondary homes. And they'd put a I guess, a moratorium on all new construction is what someone told us when we got there. Is a kind of, I thought, good idea to try and sort of prop up the secondary home market because everybody was just ditching secondary homes and it was really crushing the value. And then after we'd been there for about 2 years, they must have lifted it because all of a sudden we just started seeing, like, every day I'd go to work and I'd see another new home starting to go up. And so I was kind of seeing that every day, and I figured, you know, it's an island, it's a finite amount of real estate. So at some point, all those empty lots are going to be gone and the values are going to start to go up. And just from the pilot perspective, it's nice because I knew I wasn't going to be there for that long. So, you know, you can't, or it's harder to invest in something like a business or something where you got to be there, but a property, you know, can be anywhere. You don't need to be co-located with it. So that's the other thing that kind of drew me with it and why I think it makes sense for someone in our profession.
Yeah. And then real quick, you know, before we, and Megan, if you want to go to the next slide, before we go into, before we go into kind of the managing from a distance, right? What has your experience been just with, hey, I bought this property, I don't live anywhere near it. I know some people personally who are like, I will never buy property unless I can drive to it. What's been your experience just on like, hey, I own properties that I'm not an arm's length away from?
I probably love not being able to drive to it because it helps me keep it out of sight, out of mind. I've got a great property manager. Pretty much my dealings with it are, I pay the mortgage every month. I see a deposit come into its account every month, and that's about it. So it's, I'm in San Diego now, so it's in Corpus Christi, Texas. So it's about half a country away. And to be honest, I kind of like it that way, but that's been my experience with it.
Yeah, that mailbox money is kind of nice of just like, well, the stock market's going crazy today, but well, it's the first of the month, so I guess I have money coming in.
Yeah, I mean, I probably put about 40 seconds of effort into it a month, long enough to log on, pay my mortgage, and that's it. So I like it that way.
Yeah, perfect. So let's start there as far as, hey, if you're a pilot and you're, you know, maybe you've moved around a bunch, and Megan, if you want to go to the next slide, what has been your process for finding that good property manager who's going to make sure that, you know, places are getting rented and you know, your property is cash flowing and doing well?
Yeah, I would say you kind of can't overstate enough how important it is to get a good one. We were pretty lucky that when we moved to Corpus, our neighbor across the street was a realtor. And so when I said that we were interested in buying a rental property, like, I knew nothing. And she put us in touch with a property manager who was amazing. And, you know, I just called him. I said, hey, I'm looking to buy an investment property. And I was kind of, I don't know what I was expecting, but I think I was expecting some sort of vague advice. And then I would go out and find a property and sign a contract with him. But what I got was, I mean, this guy probably came and looked at 10 to 15 properties with me over the course of 5 or 6 months before I ever signed a single piece of paperwork with him. So I'd say finding someone you trust to give that referral for a property manager is huge because he, you know, I'll go into in a little bit, but, you know, he kind of helped get the one we got, which is what made it what it is, which is something that's one of the smartest investments we've ever made. Well, the smartest.
Mm-hmm. Yeah. And you know, I had mentioned in the beginning, you know, real estate can be amazing. It can also be really yucky, and having that person who can help avoid those situations. Because I mean, we've talked to some people who are like, yeah, when I rented a place, if I had a problem, the owner would show up in his Mercedes to fix the plumbing, and it's like, how are you, you know, why would you do that to yourself? Like,
yeah.
You know, hire out. Absolutely.
Yeah. And it's not just the effort, it's everything. So like I remember I found one and I thought, this is the house. I looked at it online. I think I went and looked at it before he did. And it was gorgeous condition, great yard, great house, didn't need a thing. And he came in and he's like, yeah, it's too small. I said, what do you mean? Like, and he's like, you're not gonna be able to get the rent you need for this square footage. You need something a little bigger. So then I found another one and I looked at that and I thought, this one's perfect. And he said, no, it needs this, this, and this. And it was finally the, you know, one of probably 10 or 15, but the third one that I saw that I thought would be the one where he was like, this is good. It didn't need much and it was in great condition. It was the right square footage for the market, would get the right rent. So it's like I said, I can't overstate even just starting the process, how important it is, in my experience at least, to get a good property manager. The other thing I did was, I'm kind of a nerd. So maybe it's in a later slide, I think, where we'll talk about the Excel spreadsheet and figuring out how much you're gonna spend and budget and all that.
Yeah, well, the next thing we were going to dive into was that expected return on investment. So we can go full bore on the nerddom if you need to.
Yeah, yeah. I'm all about going full bore on the nerddom.
Yeah.
So, obviously I was kind of nervous. This was the first big investment like that I'd ever made, and I did not want to get it over my head, and I didn't want to buy a house and find out, wait a minute, I can't rent this for enough. I can't afford it if it goes a month without lapsing. So I really kind of wanted to do my due diligence on that. So I made an Excel spreadsheet, which was pretty simple if you've got some basic Excel knowledge. I just went on to Google. I downloaded an amortization schedule. So you just put in the terms of the loan and all that. And I just added a couple things to it. I found a local insurance broker and I said, this is kind of ballpark what I'm looking at. And I got an insurance quote. And I put in the management fee, which I knew the property manager I found was going to charge 12%, taxes, insurance, all that stuff. And so basically I could put in, and I had a interest rate that I was pretty sure I was going to get. So I could basically put in the price of the house, and it would calculate everything and give you a number of what all my monthly fees were going to cost. And then I could look at the rent, and then I could just stare at the two numbers and say, this makes sense or this doesn't. So I go look at house A, I put in the price, calculates everything out. I'd go there with my property manager. He'd say, this is what it would rent for. And then it took all the guesswork out of it, or at least I think as much guesswork as you can take out of it. And then you could kind of figure out, like, does this make sense? And so I also built in I paid $50 for a home warranty. I don't know if it's worth it or not. I've never needed it, but I found the house we found, the rent covered everything plus 200 to 250 bucks a month. And so it made sense.
Mm-hmm. Now with you being on the lending side, is that when that someone is going for an investment property versus a primary residence, is that something that you at least walk people through educationally, as far as like, hey, investment properties are great, and this is why we personally try and encourage people to talk to a lender before a real estate agent, because a real estate agent is always going to be like, well, it's amazing, let's buy, right? Like the walls are painted, the trim is still intact, like look at how pretty this is. Where the lender, typically when people talk to a lender first, they're able to get that, like, hey, here's the hard numbers, and from a rental perspective, here's what you're looking at needing to cover.
Yeah, there is some things. I mean, it's not rocket science, but there's some things you want to know heading into it, I think, that are on the next slide.
Okay, perfect.
So the kind of things that you need to be aware of if you're looking at getting a loan for rental property, typically it's going to require a little bit of a larger down payment, which makes sense because an investor is taking on a little more risk because it's a second home. So 15 to 20 to 25% down is what you're going to have to put. The more down payment you put, typically the lower the interest rate is going to be. So if you can afford to put 25% down, your monthly payment is going to be lower. And where that comes into play is, I talked about making an Excel spreadsheet or figuring out what their budget is. That can help out things. So maybe, it won't rent for as much. So you want a lower monthly payment so that you're making money every month, as opposed to, or at least being self-sustaining as opposed to paying every month. Or maybe you're in a great rental market where you can rent it out for a lot. You can put 15% down and still make enough. One of the things that I kind of wrestled with a lot was, a 15-year versus a 30-year mortgage. Initially, I was interested in a 15 because I thought this is a rental property. The sooner I can pay it down to zero and, all that rent is income, the better. But I eventually decided on a 30 because I thought, what if this goes for a few months unrented? I want as low a monthly payment as I can get because then it's going to be coming out of my pocket. That's never happened. It's been rented since we got it, which has been about 6 years now. But those are kind of some things to think about before. You don't want to back yourself into a corner. Other things, mortgage rates are a little bit higher for an investment property. And yeah, like it says on the slides, you're going to need typically about 3 months of cash reserves. And that's, the investors want to see that just in case it goes unrented or something like that. They want to know you can cover it. It does not have to be just sitting in a checking account. It can be if you've got a 401k, if you have a money market account, your retirement account, it can be in something like that. But they just want to know that you're able to cover it. The last thing, kind of if you're worried about, do I have enough income to qualify? If you own your primary residence and that's what you live in, and then you're buying an income property, when they appraise it, the appraiser can say what they think it'll rent for. And it's called a 1007, where they'll let you count 75% of that as income. So say when you're trying to get qualified for a loan, if your income doesn't quite meet you with debt to income ratios of your primary and the secondary, you can count 75% of what the property will rent for, and you do not need a lease, because obviously you don't own it yet. You can't rent it out yet. But so like it says below, if it's they say it could rent for $2,000 a month, you can count $1,500 as income on your application.
Okay, so it doesn't have to have a current renter for you to attribute that number to your income.
Correct. And so that's why they build in some slop. So it's 75% as opposed to 100%, but because since you don't own it yet, you obviously can't rent it out yet.
And, just looking at where things could go wrong, have you had experiences where someone, maybe gets that projected, $2,000 a month, right? Where they're like, hey, this should rent for $2,000 a month, but they actually way low shot it, and they're saying it's only going to rent for $1,500 a month. Is there any way to, I don't know, argue that or petition for a reassessment? Or is it like, yeah, you get the, it's kind of like an appraisal, you get it, they're probably going to stick with it?
I haven't seen that. I've never seen that updated. I've never seen anybody try to update it, but I think the 25% is a fairly big slop factor there. So
okay, all right, just checking.
Yeah.
And most of the time it's just one of those. One thing I will say, for anyone listening who, for the 401k portion of it, this is something that we've run into. And Andrew, I'm not sure if you've run into, you can shed some light on this, but a loan from the 401k is not 100% guarantee. 401ks are plan specific. Have you had anyone try to get a loan from a 401k and had it rejected?
I've never had anybody try, but if someone ever got to that point, it's after it's passed out of my hands.
Okay.
Because once the loan closes and they own the property, it's kind of, I don't see it anymore. You know what I mean?
Okay, perfect. Well, if anyone does want to look into that strategy, we always encourage, like, hey, before making anything official, definitely check on if your 401k allows that. So perfect. And then so for the rules around lending, mortgage lending, there's a larger percent down. If it's a secondary residence, and you want to use it, so kind of getting into the short-term rental space, right? If you want to use it as a short-term rental and also use it as a secondary home, are there any changes to the rules as far as lending goes? Because I know you said
and for a while, if it was a secondary residence as opposed to a strict investment property, the rates were lower. So what a little bit more than a primary residence, but there was a gap there. So if you wanted, say, for instance, I live in San Diego. If I wanted to get a place in Big Bear, as long as I intended to spend time there, I could get it as a secondary residence, and then I could put it on Airbnb as well. And so it could kind of be this happy medium where I got a little better rate because it was a secondary home. And again, you have to use it. But then you could also put it on Airbnb, VRBO, and make some money. But ever since the bond went up, rates have gone up, and really they're pretty much the same now. So if you're looking at a secondary residence, vice an investment property, the rates are pretty much identical, unfortunately, because that was kind of a nice deal before.
Yeah, especially, I mean, it seemed like everyone hopped on that short-term rental option for quite a while. And then you had mentioned, Megan, if you want to go back one slide real quick, there was a little bit more information on if you're growing your real estate portfolio and you have more than 4 properties, things change a little bit.
Not really anymore. You're gonna need the cash reserves kind of regardless.
Okay, so that all stays roughly the same.
Mm-hmm.
Okay, perfect. Megan, if you can go to the next slide. Sorry about that. Alrighty. So, talking about day-to-day operations when you officially have your place and you're going into I'm a landlord. Probably the only
Mm-hmm.
time any of us get to call ourselves a lord.
Yeah.
Just the day-to-day operations of that.
Yeah. So I wanted to keep it as simple as possible. I'm simple. I like to keep things simple. So I opened up its own checking account. And so I keep it, for the most part, totally separate from my personal finances. And that's just for me to keep it easier. I don't know that I see any benefit out of it other than ease of making it all work. But so I open its own checking account. So when they pay rent, it's direct deposit into that checking account. And then I pay the mortgage out of that. I have a property management fee that's, charged right out of that. I have I think I mentioned I got a home warranty that's taken out of it. And that way it's super easy for me to log on. And so I like to keep about $1,000 or $2,000 in there, just incidentals in case something breaks. We had a hurricane go through 3-4 years ago, caused like $300 to the roof, and boom, it's not out of my pocket. It's already into the account. And then over the next couple months, I just let it build back up to where I want it. And then anything extra that comes in for rent, I just use to pay extra off the mortgage. So I like to do that just because it's simple. And then as far as, I've already talked a little bit about the property manager, but that was kind of more from the buying perspective. But once you own it, I would say we've seen tenants rotate a lot more than we expected. In our house in Texas, I think the first few years, maybe the average tenant was about 9 months. And since then, it's been about once a year. We had the same experience when I was living in Texas and we were renting out our home in San Diego. Every year, about the tenants moved out. So the advantage of a property manager is, people say, oh, I don't want to pay that property management fee. But when tenants move out, particularly the house in Texas, every time tenants have moved out, they had someone ready to move in immediately. So, tenants might move out on Monday, Tuesday, Wednesday, they're cleaning, new tenants move out on Thursday. So they keep it filled. Whereas if I was trying to fill that, if it goes 2 weeks, 3 weeks unrented, that's pretty much my property management for the fee that year that I just burned. So they're a huge advantage from that perspective. And then they just handle everything, like all the cleaning, our last tenants were there for about 3 years. So when they moved out, they took great care of it, but there was little things like cleaning, yard work. They can take care of all that. I don't have to worry about it. It's just automatic. So I'd say I can't overstate enough the benefits of it from that perspective.
Okay. Yeah. When you have a vacant property, you're like, man, my ROI is crashing pretty drastically now.
Yeah, I had a neighbor that lived on my street there that moved out, and they did not want to spend the money on a property manager. And I mean, that thing sat for months, and I just thought, it's just burning money,
Yeah.
So I'm happy with my choice.
Yeah. Now, other considerations when it comes to the investment properties and the purchasing other properties. I mean, if you were to dump that one in Texas and get another one, what can you, if someone's not currently in the real estate game, what can you tell them about 1031 exchanges? How useful that has been for you, for your clients, and a little bit more on that topic.
So a 1031 exchange is, the tax stuff starts to get a little bit more into your wheelhouse than mine, but essentially what it is if I were to sell my house now, so I bought it about 6 years ago, and I've paid some off the mortgage, but more than that, it's appreciated. I'd say it's gone up probably about 70-80% in value, which is awesome. But if I were to sell it right now, I'd have to pay taxes on all that stuff, capital gains taxes. So a 1031 exchange, I could sell it and get another investment property and avoid the taxes. But that's that's kind of more your wheelhouse than mine, is the actual tax stuff on that.
Mhm. Yeah.
But it's,
I was gonna say, but has that, I mean, has that been a relatively, as far as mapping out the taxes, that's one thing, but is it a pretty relatively easy process as far as, hey, we're selling this place, we're gonna 1031 over here, from a lending standpoint? I mean, is any complications there, or?
no, it's pretty straightforward.
Okay.
Yeah, but it's just a nice way to not have to pay taxes, every time you want to switch a property or something like that.
Yeah. Taxes are the other killer on your return on investment. So,
Yeah.
vacant houses and paying taxes when you don't have to.
Yeah.
So that's money not coming in and then money leaving unnecessarily. Those are two ROI drainers. So when purchasing your, let's say you have two properties, when purchasing your next property, right? When do things get a little bit more complicated as far as, maybe you have an ample amount of debt, right? Or, do you ever run into situations where someone's looking for that next property and you're like, hey, we need to be careful because, again, either we're buying houses that are too expensive, we need to do something, a little bit more cost effective. Anything around that arena?
I mean, you still need to keep that, 3 months or so of cash reserves. So as you buy more properties, the amount of cash you need to keep available to you starts to go up. But then I think you just also want to be careful. Anecdotally, there was another Navy guy that when everything crashed, he built up this great portfolio of rental properties. But when everything crashed at once, he couldn't pay the mortgages on all of them. They're all underwater. And he had to declare bankruptcy. So it's just sort of something you need to keep in mind, that you don't want to overextend yourself, because you get one house that's covering itself great. You get two houses covering themselves great. But you don't want to get so overextended, I would say. It's just my personal opinion. You don't want to get so overextended that everything ever happened, you couldn't cover yourself for a reasonable amount of time, because markets change, rents can change. If property values ever crashed again, you don't want to be underwater on, if you're underwater on one house, you can probably handle that. But if you get 5, 6, 7, things could start to snowball pretty quickly. So it's just something you want to think about.
Yeah. And I feel like we're so far removed from, that 2008 crisis that some people forget about how drastically, leverage is awesome on the way up and that it is a B on the way down, right?
Yeah.
You run into those, I didn't know him personally, but a friend knew someone who I think they went from, and they were in their 30s, they went from like over $100 million, real estate portfolio to being, filing bankruptcy because they were negative $10 million, right? And it was just one of those like, oh, I just get another place,
Yeah.
So that can be tricky. So, and then on we did have a question come in on buying the next place. Someone asked, okay, so if you have enough equity in your home, can you do a cash out refi of like your primary residence to go buy an investment property?
You could. Yeah, you could do a cash out refi. And then you just want to, before you do all that, you want to make sure you have the debt to income ratio and all that to still get another place. But you absolutely could. If you have a lot of equity in your house, you can use it. I think it makes a lot of sense.
Yeah. And I think the obvious caveat there is, we're back into the leveraging game, right?
Yes.
Where it's like all of a sudden you're, just because you can do something, definitely pull out a calculator, talk to a professional, and because that can get messy. Awesome. And then for making sure, because obviously real estate's been booming for quite a while, right? There's a ton of real estate agents out there, ton of lenders, ton of property managers. What was kind of your process, or what do you typically coach either friends or clients on? Like, hey, here's how you get the right group of people to make sure we're kind of checking all the boxes and not getting ourselves into a sticky situation. Because again, real estate, amazing asset class, amazing, net worth builder. can be done wrong, can backfire.
Yeah, and I mean it kind of sounds cliche, but it's always served me to go with the people you trust. So like, when we got this rental property, for instance, we didn't just Google realtor. Like, we had a neighbor across the street. We'd known her for a couple of years. We trusted her. We were friends with her. And because I trusted her, I trusted the property manager. So that, I mean, it sounds cliche to say find someone you trust, but it's pretty simple. That would be my best advice for people.
Yeah, perfect. Well, we have a few more questions that have trickled in, and we'll try to get to all of them before wrapping up. We had one come in that was, what are some of the red flags people should be on alert for if they're getting approached by someone who is telling them to do a cash out refi or a refi, right? If they're getting approached by lenders.
Yeah, if it's someone you trust, sometimes it makes sense. Like when just refis in general, like obviously last year it made sense when rates plummeted. But the thing you have to keep in mind is, some lenders might just keep going after you because they want the business. And every time you do a refi, they get a cut and it may not make sense for you. So I fall back on my nerddom. I have my Excel spreadsheet. And when rates was falling before I got involved in this profession, I would figure out, again, I would just put it in that Excel spreadsheet and say, if I refi, there's a certain amount of fees that are going to come with that. And I could just put it all in, like, yeah, give me a quote, and I could put it all in. And I could see that, yes, I'm going to add to my principal, but if the rate goes down this month, or, this much, then after 14, 16, I'm just making up these numbers, but after a certain amount of months, it's going to pay itself off and it'll make sense. But, I've had personal loans with lenders in the past. Before I was involved in the profession, it was like every 6 months I started getting spam calls, and there is some of that out there because not everybody cares if it's a good deal for you. A lot of them just want that fee, and they need to keep business rolling. So definitely be skeptical and do your own research, because I think we've probably all seen that, where you just start getting that spam call every 6 months. Hey, have you looked at a refi? No, because it doesn't make sense.
Now we had another question come in. Someone who's obviously a bit tax savvy and wants to dive down the tax benefits rabbit hole here, which we could do. I mean, we could do an entire other episode just on tax benefits.
Yeah, tax benefits aren't necessarily my area, but I can take a crack at it.
Well, what he was asking was, what are some of the tax benefits of having a rental property, and what can you write off against your personal income?
First off, when you buy one, a lot of the closing costs and stuff are write-offs. But after that, again, I go with my hands-off thing. We have a guy that does our taxes. I just send him everything, and our tax returns are pretty friendly every year. But I couldn't tell you I mean, that's more for you to speak to, I think, specifically. But I don't know what specific parts of it he's writing off. But
yeah.
He does he's a professional at that. I'm not.
Yeah. And for any of our attendees, we did have a pilot who was a CPA on a webinar as well. So that's absolutely, there are tax benefits, but it is going to depend situation to situation. We had another attendee who asked, do you have any thoughts or interest in apartment syndications?
Apartments and condos can get very hard. Just as far as ease of getting a loan, freestanding homes are typically a lot easier. The one thing I will say they could make, if there's like an apartment or condo that you're looking at or that fits your price range, one of the things that can make it a lot better is if you put at least 30% down. You can get what's called a limited review, which makes the paperwork and getting the loan a lot easier. But so other than that, I haven't personally looked at getting a condo for myself, but that's kind of the main thing I would say is if you can put 30% down, it's going to make your process of getting the loan and the paperwork a lot easier.
Yeah. And that's another one of those, like we could probably spend an entire episode on, or entire webinar on that. And maybe, what we'll probably do is do a follow-up webinar on just, the real estate syndication deal.
Yeah.
So, but great question for, for the person who
Yeah.
asked that, and for the tax benefits, because those are two things that, we'll definitely cater some more content towards that. As far as red flags, someone asked a question on the property manager side.
Mhm.
As far as some red flags, when it comes to property managers, have you either not yourself, but had someone else have a bad property manager experience? What are some things to look out for to make sure your properties are cash flowing and do what they need to do?
I haven't had any personal bad experiences. Again, mine's been great. As far as people that I've known, unfortunately, it's kind of once they close with us, a lot of times that's the last we hear from them.
Mhm.
So I haven't had anybody come back to me and said I had a poor experience with property manager, but I think that's probably in part because a lot of it's mitigated these days, but there's just so much information out there where if your realtor doesn't know somebody, you can look on Google. There's so many reviews out there where I think you're not as likely to get blindsided by a bad property manager as you might have, 10, 20 years ago before there was all this info out there.
Mhm. Mhm.
So I'm sorry, I can't give you a better answer, but
Yeah.
I haven't.
Well, if anything we've learned, Andrew needs to go play the lottery. Seems like he's always having good experiences with the whole process. Like, I want to buy the lottery, the ticket either before or after you too.
We really did get lucky with the timing of it and who we ended up with. Like, people were like, "What did you learn?" And honestly, I come away with just positives. We didn't really have anything along the way. We're like, "Oh man, that was a tough learning experience," but it was just, I think we had a lot of luck, and then we did our due diligence, but we had a lot of luck with the timing and the people that we were able to find to help us along the way.
Yeah. So another question did come in on, so if someone is if someone is going to be looking at, obviously this person is going to be looking at real estate property, not in the short term, but in the future, what are some things that they can do within a year to make themselves look better from a borrowing standpoint?
From a borrowing standpoint, we talked about a couple of the main things. You want to make sure that you have some cash reserves saved up. And then obviously you want your credit. You want your credit to be good. The better your credit is, the lower, obviously if your credit's below a threshold, you're not going to be able to get a loan, period. But as your credit goes up, you're going to be able to get a better rate. And then if you do have a year, I would say that's also where maybe you want to search for, a little unrelated to your question, but where you're going to rent. Looking at property value, I'd say where you buy can have a big impact. Like, we got ours on the island specifically because it was affordable, but it was a finite amount of land. It didn't have very many empty lots left. So I was just looking at the rate they're building, saying at the rate they're going, in 5-6 years, there's not going to be any empty lots left. And then you can't just buy a lot for 30 grand and buy a house on it. You're gonna have to wait till a house that suits your needs comes for sale. And then I was hoping that would make the property values go up. And so that's the main thing, just your credit, get some cash savings up, and then use that time to kind of look for where you want to rent, maybe find that good property manager that's going to help you find a place.
Yeah. And then this one's, this is a question driven by me, because that's the person who's looking at the long-term, which is great. We love long-term thinkers. But if someone is starting the process today, what should they not be doing to really disrupt the lending process?
It's not be doing is just, I'd say the biggest thing is don't be slow. When we lock a rate, we lock for a finite period of time. And, the reason we do that is because rates are constantly going up and down, these days hourly. So when you start the process and you go under contract, you get locked in at a rate. That's only good for a finite amount of time. Might be 45 days, might be 60 days. The longer you hold that rate, the slightly higher the rate's going to be. So if you're starting this process and they're emailing you saying we need your tax returns or your income statements, the sooner you can get that, the better, because especially when you're buying an investment property, the underwriters, who are the people who are really taking everything and making the ultimate decision, they're much more sticklers when you're buying an investment property as opposed to your primary residence. So what you don't want is to, you waste a week or two getting the things in that they're asking for. And then down the road, when your lock's getting close to expiring, all of a sudden, these little things pop up and you don't have time to take care of them anymore. And then you have to pay to extend the lock, or you lose the house. So the biggest thing I would say is just be as timely as you can. If they ask you for something, get it in as quick as you can, because ultimately it's yourself that you're doing the favor that, if you get in a time crunch because something unexpected comes up, you have that time to take care of it.
Yeah. Yeah. And got a fairly active group here, because someone just chimed in with, if you get a rate locked and rates start going down, is there a way to capture the lower rate, or are you stuck with that rate that you locked in at?
If rates go down, you can relock, but the way things are going right now, I wouldn't anticipate that.
Yeah. Yeah. Which that's the I won't say the gamble, but that's that is kind of the interesting piece of the puzzle.
Yeah.
Perfect. So we'll maybe see if there's any more questions out there. But I think that I think that was it. And again, if anyone is interested in this, feel free to to follow up. Do your own research as well. And Andrew's been a great resource, at least for us, on just, hey, how are things looking? What do we need? On the lending side. So he's been awesome in that capacity.
And I'm happy to talk with people if anybody needs my email address or cell phone number. I think I'd gone through this process 11 times before I got through this job, just in moving with the Navy and getting new houses, refinancing as rates went down. And I was still kind of shocked when I started this profession how much I didn't know. So I'm happy to just educate people if anybody has any questions. And my company was started by 2 airline pilots. Most of our loan originators are airline pilots. So we're pretty familiar with pilot pay and how all that works out. So it can make things a little smoother sometimes.
Yeah. So pilots working with pilots. It's,
Yep.
Awesome.
Fabulous. Well, thank you guys. I really appreciate the time and effort that you put into this presentation. It was very interesting. And I think it's applicable to lots of groups outside of pilots as well. I certainly learned plenty from it.
Awesome. Thanks for having me.
Yeah. And on behalf of Advice Chaser, I want to thank you and the folks who attended today. We appreciate your time and attention. The attendees can look forward to an email with a link to a replay of this event. And you're welcome to share that replay with anyone you think would benefit from it. And at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you. Every one of our advisor partners has committed to offer free initial consultation to anyone we introduce them to. And you can find out more by going to advicechaser.com and clicking on the link to find an advisor. So once again, from Advice Chaser, thank you all so much for coming, and we'll see you at another webinar soon.
Thanks.
Thank you.